Okay, so today we're going to talk about probably one of the most important topics that new buyers need to know about is understanding the options that are available out there. The lending world we live in today is a lot different than it was 4 or 5 years ago. So basically, about 95% of all mortgages are kind of done in these boxes. It's either conventional, FHA, VA, or USDA. And quite frankly, VA and USDA aren't really even utilized that much. So majority of loans are conventional, like Fannie Mae and Freddie Mac loans, or FHA. And this represents 95% of the buyers out there will fall into these boxes. And really, every bank offers the same things. So whether it's Bank of America, Wells, Chase, Cobalt Mortgage, or any broker that's out there, everyone's offering the same stuff. So hopefully that makes sense. So let's jump into first conventional, or Fannie and Freddie, which is over here on the left. So some of the positives to this program are you can do as low as 5% down, but that 5% must be your own funds. It cannot be a gift. The conventional is very credit score driven, so the higher credit score you have, the better interest rates and terms and conditions you're going to get. If you're putting less than 20% down, you're going to have mortgage insurance. But on the conventional side, we can be a lot more creative with the mortgage insurance, meaning it can be monthly, it can be paid up front, it can be financed into the loan amount. Tons of different things you can do with that. You can do fixed rate and ARM programs, and you can do loan amounts up to $506,000. Okay, so that's just the general overview, and conventional is a great way to go for most buyers. Now, FHA is a great loan program as well, but that has a little bit more twists and turns to it. FHA is great because you can put as low as 3.5% down, and all those funds can be from a gift from a family member. So what's nice about that is you could maybe not have a lot of money saved up or enough for the down payment, but you can do as low as 3.5%, have a gift from a family member to cover all of that. The credit scoring is very liberal, so even if you don't have perfect credit, you're still going to get great interest rates. So your interest rate is not driven by credit score as much as the conventional side is. The negatives are the mortgage insurance is a little bit higher, and you have an upfront mortgage insurance premium, which we can get into when we meet. But again, that is something that is a little bit more unique about FHA. Very competitive rates again for ARMs and for fixed. And FHA is also a little unique in that you can do loan amounts up to $567,500 as opposed to the $506 on conventional. Now VA, I'll go over that quickly. That's the only real one of the only real zero down programs, but you do have to be a veteran and be eligible for the program. And then USDA is another low down to zero down program, but you do have to buy in USDA approved areas, which tends to be rural housing, kind of out in the more rural parts of the state. So that's just a quick overview of different loan programs available. Anything outside of these boxes is more portfolio or jumbo base, and we'll talk. Well, that's a little bit more different kind of rules.